Hello traders, Igor here, MrTopTick.com. Today I want to talk about one of the most important aspects of trading. This is one of the most important topics for me when it comes to trading, which is risk management. One of the rules that I apply to my trading is, number one, only risk what you're willing to lose, and two, never risk more than what you're willing to lose. We're looking here at a daily chart of Starbucks, SBUX. I took a trade earlier today. A couple of reasons. So this is a daily chart, and we can see that overall Starbucks is still in an uptrend as it is making higher highs and higher lows. Today we are underneath a 50-day simple moving average. I think we're headed to test 82 and potentially might test 80 level, which was a level of resistance going back to June and then again in early July. So as I was looking for a move down to about 82, maybe 80, what I did was I took a long position in the November 18 expiration cycle with 57 days. I picked up a 90 put. I was able to buy this put for $5.85. So the risk in this trade is $585. Obviously, the trade is now moving in my favor. This trade is currently showing a gain of about $195, which represents about 33% return on risk. There are several ways to manage a position like this. The simplest way to do it is to just go out and sell this put to close, collect 30% return on your investment and be done with it. This would be a day trade. Or since there are 57 days to go, and I still think that there's more downside, we haven't really reached the target levels that I'm looking at. A couple of adjustments that I wanted to mention here. So number one, I can go out to say October 21st expiration, 29 days, and I can sell a put against my long put, making this a long put diagonal spread. So if I sell a put at the money for $3.30, I will collect $330, which will go to offset my risk from $585 down to about $260. This will obviously change my risk profile, where I will have less short delta. I'm also going to go from negative theta to positive theta, which is good if you're looking to generate some income while waiting for price to reach your price targets. But there are two things. Number one, I am giving up potential reward on the downside underneath somewhere around 81.75. So that's a negative. But in return for this negative, there's something positive. And the positive is I get to reduce my risk from $585 to about $260. So I get less risk, but I get less potential reward, right? Game of trading is all about give and take. So we're giving up potential upside, but we're also able to remove a big chunk of our initial investment. And who knows, maybe as Starbucks continues to go lower, maybe we can add risk back on. If it rallies, obviously, being in a diagonal is a lot more advantageous than just being in a long put, because, holding negative 64 delta versus holding negative 15 delta, if the stock rallies, holding negative 64 delta is going to be a little bit more painful if the trade starts to go against us. Another potential adjustment I wanted to mention real quick. This is probably one of my favorite ones. So converting a long put into a broken wing or a balanced put butterfly. We know that butterfly is structured as in 1, 2, 1. So we're long a put, we're short two puts, we're long a put. Right here, right now, we're long a put. If I was to sell 2 85 puts in the same expiration, 57 days, If I was to sell 285 puts and buy 182.5 put, this is how my risk profile is going to change. If I sold 285 puts and I bought 182.5, I will collect about $6.15. Remember, my initial outlay was $585. If I now collect $6 credit, I not only take out all of my risk, I also end up with a slight net credit to hold this position. That's a positive. What is the negative? The negative is that I'm going to give up potential reward on the downside somewhere underneath 81.36. So I just wanted to bring this to your attention, let you know what's possible when trading options. And this is one of the key benefits of trading options compared to just trading stock, right? With stock, you could be either long or short, nothing in between. With options, you can be short. While you're holding a short position, you can convert this position by selling options against your long options. You can effectively take out a lot of your initial risk. You can trade around your core position. I hope you found this helpful. If you did, like this video, subscribe to our channel, share this video with someone you think could benefit from it. And as always, if you take care of the risk, the profits will take care of themselves.